Hello and welcome. I'm Saeed from storyplanet.net. Dive right into the essence of the most captivating books without reading them cover to cover. Whether you're on the go, at the gym, or just relaxing at home, we offer you a unique and enriching listening experience. Today, we are exploring the book, Austerity, a creation by Mark Blyth. Austerity, 2013, sheds light on the turmoil surrounding our recent financial crises and exposes the true consequences of implementing austerity measures. In this scenario, budgets are reduced, public funding is drastically diminished, and ordinary families bear the brunt of the burden in order to save banks and sustain their immense profits. Discover the reality of the situation and uncover who truly benefits when a nation is pushed towards austerity. Before we delve into these revelations, it's interesting to note that Mark Blyth, a professor at Brown University, is renowned for his critique of austerity politics. His area of expertise lies in political economy, and he is the author of the influential book titled Great Transformations, Economic Ideas and Institutional Change in the 20th Century. With 6 key ideas to unveil, brace yourself for a deep dive into this captivating book on storyplanet.net. To start, austerity programs designed for countries in crisis are likely to fail due to various factors. These programs typically involve stringent spending cuts and tax hikes, aiming to reduce government debt and restore economic stability. However, they often overlook the negative consequences of such measures, including decreased economic growth, increased unemployment, and social unrest. Additionally, austerity can exacerbate existing inequalities and hinder long-term investments. Therefore, an alternative approach focusing on sustainable economic growth and targeted reforms is crucial to effectively address the challenges faced by countries in crisis. In the aftermath of the global financial crisis, the Eurozone faced a debt crisis supposedly caused by overspending in countries like Greece and Spain. However, blaming these countries and advocating for austerity measures is misguided and ineffective. This summary explores why this approach is flawed and discusses alternative solutions. Key idea number 1: austerity measures not only harm a nation's economy, but also disproportionately affect the most vulnerable members of society. The financial crisis that originated in the United States in 2007 had a significant impact on Europe. A policy called austerity, which involves reducing spending through budget cuts, was proposed as a solution to revive the European economy. However, austerity is not a one-size-fits-all approach and can be dangerous when applied to a nation as a whole. Evidence from countries like Spain, Portugal, Greece, Italy, and Ireland shows that austerity weakens the economy rather than boosting it. By imagining a situation where every household in a state simultaneously cuts back on spending, we can see how this leads to a decline in business activities and a build-up of debt. Austerity measures also tend to disproportionately affect the lower classes, as welfare programs and unemployment benefits are often slashed. In times of austerity, it is the average worker who suffers the most, while the bankers who caused the crisis remain relatively unscathed. Key idea number 2. Throughout history, it is evident that implementing austerity measures as a means to revive the economy has proven to be ineffective. Slashing budgets and implementing austerity measures during tough economic times may seem like a sensible approach, but historical evidence tells a different story. Austerity has consistently failed to revive economic growth. Examples from the past, such as the United States in the 1920s and Germany after World War I, show that austerity only led to further recession and suffering for the population. It was only when countries like the US under Franklin Roosevelt and Sweden, France, and Japan reversed their austerity measures and increased spending that their economies started to recover. Some economists may argue that there have been successful cases of austerity, but these examples are highly questionable. The positive examples often occurred during times of economic growth or had other factors contributing to their success, such as devaluation of currency or specific policy measures. Ultimately, the notion that austerity is an effective solution is not supported by reliable evidence. Key idea number 3. The economic crisis stemmed from the US banking system's shortcomings and the widespread default of mortgages. The 2008 financial crisis was caused by the US banking system's involvement in risky borrowing and lending practices, not government overspending as many believed. Banks traded housing mortgage securities through repo markets to save money. But when homeowners started defaulting on their mortgages in 2007, the securities became worthless. Media coverage of the crisis led to widespread panic and bank runs, exacerbating the problem. The crisis was further fueled by the use of collateralized debt obligations, CDOs, and credit default swaps, CDS. CDOs bundled mortgage securities together, while CDSs allowed investors to bet against banks and receive payouts if mortgage owners defaulted. Insurance companies like AIG sold a large number of CDSs but couldn't pay for them when defaults increased. Investors tried to sell CDOs at reduced prices, leading to a crisis that also affected Europe. Key idea number 4. The struggling EU nations worsened their situation by bailing out the banks, exacerbating their existing challenges. In 2008, the European banking crisis hit hard, especially for Portugal, Italy, Ireland, Greece, and Spain, known as the PIGS nations due to their poor economic policies. These nations were already struggling with economic growth, including issues like low birth rates, an aging population, bursting property bubbles, and lackluster industries. To make matters worse, their adoption of the euro limited their ability to handle crises independently. Instead of finding creative solutions, the decision was made to bail out the banks, which resulted in permanent austerity for the PIIGS nations. This move was driven by the belief that the banks were too big to fail, but also too big to bail due to their dangerously high value. As a result, the PIGS nations were left with little resources to invest in other areas. Key idea number 5. While Ireland has faced challenges due to austerity measures, Iceland has experienced success by allowing its banks to go bankrupt. Ireland's economic recovery through austerity is often held up as a model for Greece, but closer examination reveals that Ireland's economic health is not as enviable as it seems. Despite spending $70 billion to bail out its banks and implementing austerity measures that included salary cuts and reduced social benefits, Ireland's growth was minimal, mostly coming from foreign companies taking advantage of reduced taxes. Unemployment rates skyrocketed and the debt-to-GDP ratio increased significantly. In contrast, Iceland, which faced a similar situation in 2007, chose a different path. It allowed its banks to fail while supporting social benefit programs, raising taxes on the wealthy, and devaluing its currency. Iceland's GDP only dropped by 6.5% in 2009 and 3.5% in 2010, and it experienced positive growth in subsequent years. This shows that austerity, although beneficial for banks, is not in the best interest of the nation or its citizens. Key idea number 6. Alternative economic approaches exist that prioritize the well-being of the majority over a few individuals, offering viable alternatives to austerity measures. Instead of relying on austerity measures and bailing out troubled banks, we should consider alternative approaches to economic recovery. Iceland's example demonstrates that allowing banks to fail and using a portion of GDP to fund new banks can be a more cost-effective solution. Additionally, raising taxes on the wealthy to reduce debt can have a significant positive impact on a country's economy. By prioritizing the majority over a select few, we can find creative solutions to future financial crises and make better choices going forward. In conclusion, the global banking crisis, triggered by the private sector, burdened the public with the costs of bailouts, leading to cuts in public services and social benefits. This disproportionately affected struggling families, while the wealthy remained sheltered. This exposes the pitfalls of using austerity measures to achieve economic recovery. By enhancing public awareness of past events, we can explore alternative approaches and usher in a future crisis response that is more equitable. Thank you for listening to this summary. If you enjoyed this exploration, we invite you to discover other fascinating books on storyplanet.net. Don't wait any longer. A multitude of books, stories, and knowledge await you there. See you soon on storyplanet.net.